You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. And before we begin today, I want to remind you there's a website associated with this podcast called wealthformula.com. And if you would like to potentially sign up for some of the things on there, such as our various lists, including the Accredited Investor Club, go check it out. Go to wealthformula.com. We've had lots of good stuff coming through there. But of course, it's only for those people who've onboarded into our Accredited Investor Club. It'll just require, just some paperwork and a little discussion and that kind of thing, but easy to do and certainly worth it if you are looking to potentially get into alternative assets. Let's talk a little bit about a different kind of asset today. It is, by the podcast for this week is actually, by popular demand, a replay of the webinar hosted by our friend Rod Zabrieski of Wealth Formula Banking fame. And he's going to be talking in this about a concept called Wealth Accelerator. Well, let's start with this. So investment advisors, I'm sure you've heard this story because I heard it when I first got out of training as well. They like to tell their clients that there's no value in permanent life insurance. The old saying is buy term and invest the difference. And that's fair. The problem is it's not really wealthy people are doing. So if that's the case, why would they say that? If it's not in your best interest and if that it might have value for you? Well, one of the reasons is that, the money that people typically use for these kinds of things, money for anything, finite, right? And if you are going to take it out of your investment portfolio in which an investment advisor is paid assets under management, then that's less money under management and less money for the advisors. So I think that has become sort of the Wall Street mantra, but I don't think it's completely without bias. I think it's because of this reason. So, there is a conflict of interest at play, and people may actually believe this, but I think the reality is that they probably haven't dug deep enough. It's the same conflict of interest that makes those managers dissuade you from investing in alternative assets. And so you might hear those kinds of objections as well. But here's the reality. Permanent life insurance designed as what are known as life insurance retirement plans, or LIRPs. Just look it up. You'll see it's left and right. And they're designed for cash flow after accumulation of wealth. They are also designed for huge estate planning vehicles. That's what they do. The rich are notoriously using these things for that purpose. And so it's important that you know why, because I wondered the same when I first started exploring this stuff. So listen to the discussion from Rod, and you'll understand how these things are engineered and why they're valuable. If you'd like to watch the webinar instead and see some of his slides, go to wealthformulabanking.com, and it was updated as a Wealth Accelerator video there. One group of individuals that I believe can find particular value in this Wealth Accelerator concept are the people like doctors, for example, who were stuck in residency training while their colleagues were accumulating money in the workforce. I totally get that. I was one of those people. By the way, I do have a Wealth Accelerator policy myself. And, I talk to people like that every day, and, they're making good money now, but they feel behind. How do you feel behind when you're making $500,000 to $1 million a year? Well, you lost a decade where other people were other people were making money. So, in the meantime, you're a resident, like a surgical resident, like an indentured servant or something. Of course, it's not just doctors. Anyone who started making money later in life understands this and could be in the same situation. And for those individuals, you will see why the design of the Wealth Accelerator may be the answer to some of those sleepless nights. Anyway, check it out. Rod Zabrieski is going to give you a presentation right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Hey, everybody, this is Buck Joffrey. Thanks for joining this webinar. I want to take this opportunity to introduce you to Rod Zabrieski. Of course, many people know Rod already. He is one of our original partners, one of two with Christian Allen on the Wealth Formula Banking concept. They've been working with our group for many years. And the Wealth Accelerator is something that was presented to me the first time, I think what it was, maybe a year or 2 years, maybe maximum 2 years ago, which was sort of really mind-blowing from the math. And, a lot of the times when you see something like this, your natural inclination is to say, is this too good to be true? And the reality is that, the more numbers oriented you are, the more mathematical you are, the more you will be incredibly impressed by this, because it's just math. There's no magic to this other than the math that's used. And it's an engineered form of wealth creation. And so, so excited to share it with you. And to do that, we have Rod Zabrieski. Rod, how are you?
Hey, I'm doing great. Thanks for putting this together, Buck. I know that we've had couple of podcasts where we've talked about this. We've had a webinar out there. This is a good time, I think, to refresh on the concept, maybe get into a few different details than some of the things we've talked about before. But to begin with, I want to just kind of lay the groundwork and just basically introduce what is the Wealth Accelerator. Well, at its most basic form, it is a way to create maximum tax-free income. And typically we talk about this in terms of income for retirement, right? But really it could be anything. If you're thinking, hey, I have money I want to set aside today and I don't need it now, I want to access it in the future. It could be for kids' education. It could be for something business related, for estate planning related, you name it. And this can fill that role. In the context of today, we will primarily focus on it from the standpoint of that retirement income and then some estate planning, but just realize it can be used for any of those purposes. It's a great way to create predictable double-digit returns. And we'll kind of show you how that works as we go through this. But again, it's just the math, right? It's leverage and it's the math. And it's a really good way to put inactive money to work. Now, in the last few years, we've had a lot of people who we've talked with who wish they could be out investing in certain things, but they felt like, man, I'm a little scared right now. And so I'm going to just be sitting on my money. Well, a lot of those people, when they learned about this, decided, hey, I'm going to actually take that money. It's a good time to put that into something like this. And so we've seen a lot of people doing that. And also in terms of inactive money, a lot of businesses have to keep a large amount of reserves on hand, right? Because you got to make payroll, right? You have maybe unexpected expenses that come up. Maybe income can vary from, quarter to quarter or whatever. And so you have to keep some reserves, but it hurts because we're usually keeping them in a liquid place like a bank account. We're just not really doing a lot for us. Well, this will show you a way where you can potentially use a portion of those reserves and have it working for you, but still have access to it. And that's this next point. You have checkbook access and liquidity for short-term needs. It provides valuable liquidity for your estate. Again, we'll get into that a little more here in a minute. And the last point, it's optimal leverage with no outside collateral. And that leverage piece is something I want to hit on here for a minute. We use leverage in a lot of ways in our lives, right? If you're a business owner, chances are you use loans as a portion of what you're doing in the course of running your business, whether it be to buy equipment or inventory or again, payroll, having a line of credit out there that you can access when needed. So we're using leverage. In our real estate investing, in really a lot of the investing that we do, we use leverage. And why do we do that? Because we turn an asset that creates some sort of return, say it's an 8 to 10% return on its face, but then the return that we can get, we amplify that when we add leverage. So turn an 8% return into 20%, whatever, right? Now, we always have to be careful. We use the term of being cautious in the way that we do use leverage, conservative leverage. In this case, what we're showing you is something where it's all self-contained. So there are versions of this where you have to actually go out and post collateral from some other assets that you have, a brokerage account or CDs or something else. And I just want to make really clear right up front, that's not the case in what we're going to show you. 100% of the collateral that you need to cover the leverage, the loan that you're using, is going to be contained within the plan, okay, within the Wealth Accelerator strategy. All right, so with that kind of as an introduction, let me just first talk about the flow. Like, how are we doing this? How are we creating this? What's the process? Well, the first thing is we're going to set up life insurance policies, and we're going to put money into those policies. We'll get into a little more detail on what those are specifically, because we actually have a couple of different types that we're using, and so we'll get into more detail. But the idea is that we're putting money into these max overfunded life insurance policies. When we do that, now we have cash value in the policy. That's an asset. Okay. And what do? Then we contact a bank and we set up a line of credit using this asset that we've created as collateral for that line of credit. And just as any other line of credit, if you have a HELOC, it just sits there and is usable to you when you're ready for it. But otherwise, it just sits there and no balance or whatever, right? Well, that's kind of the case at the starting point. And when I talked earlier about the fact that we have checkbook access, that's how we have that access. We're actually accessing it through that line of credit if we have some need, again, emergency fund type of access. But the point is that it's there, it's liquid, we can get access to it. Really what the line of credit is going to do for us, though, is we're going to tap into that line of credit to continue to add funds into the life insurance policies. In other words, using leverage to build an asset, right? We got it started, that initial money here from our friend here, Dr. Z, he put the initial money in, that created the asset that allowed us to set up the line of credit. Now we're just tapping into that line of credit to continue adding money into the policies. We increase the value of the asset. But every time we increase the value of the asset, the line of credit goes up. And so year by year, we're accessing this line of credit to continue to build this asset. Okay. So over time, we have a large asset. We can add additional policies. We'll talk through what that might look like. And then ultimately, we're going to get to a place where we can take off tax-free income. And when we're doing that, again, it's because we've used the leverage that we can create as much income as we can. And we'll get into some examples. But really the benefit is, like I mentioned a minute ago, in real estate, if I can turn my 8% return into a 20% return by using leverage. In this case, we're using life insurance policies, which can, would produce around a 5 to 6% net return after all costs are considered, and turning that into something where with the leverage, it's more like a 12, 13, 14% return. And that when we take that income, we can just get a lot more income because we use the leverage than we would be able to if we hadn't.
Sometimes the way to think about this is if you're a real estate investor, which a number of people who follow me is that the actual rate of return becomes sort of your cap rate. And the leverage is like your mortgage. So the reason you use a mortgage when you buy real estate is because you're taking that cap rate, which is essentially the net operating income if that property was not leveraged, and you are amplifying it up, right? So I think Rod is giving you that 5% example. I mean, for example, that would be like a whole life policy, right? I mean, typically a whole life policy, and you'd say, well, why would you do that instead of some other asset? I think Rod would tell you that one of the great advantages of these life insurance policies is that they're extraordinarily stable, right? They're not your typical volatile asset. Maybe you want to get into that real quick.
Yeah, you're absolutely right. And we'll talk in more detail, but we're using whole life and we're also using index universal life. And we'll talk through the differences, what they are, why we choose to use the combination of the two. But in both cases, one of the primary characteristics is that consistency and predictability of what they're doing over long periods of time. So we've talked through what it looks like while Dr. Z is living. He's taking that income. Well, eventually, when Dr. Z passes away, because it's life insurance, there's going to be this death benefit that pays out to his kids, his heirs, and it can provide for a lot of different needs. We call it estate planning needs, but that could include state taxes. That could include liquidity, like when you're passing on the real estate or a business, these non-liquid assets. It's hugely valuable to have cash that passes along with it so they can take care of all those needs without having to start liquidating assets just because they need cash, right? So it can provide for all of those needs after you've passed. Okay, so let's get back to the vehicles. So we talked about how there are two different types of life insurance that we're using. And at its core, it's the asset, right? It's the cash value that's sitting in the policy that we're primarily focused on, because that is what we're creating as this asset. That's what's acting as collateral when we go out and set up that line of credit. The first type that we're using is what's called index universal life insurance. And in all cases, every time we set these up, same is true with wealth formula banking. If you're familiar with that strategy, when we set these policies up, we're setting them up with maximum cash value, minimum costs, right? We want as much as of the money that we're putting in there to go into the cash value in the asset as possible. And so max overfunded. When it comes to the actual cash value, when it's in the policy, it's going to be growing over time. Well, the difference between these two types of policies is the way that cash value grows. In the case of the index universal life, it gives us more upside opportunity. Okay, we like that because it's linked to a market index. Now, to be really clear, it's not invested in the market. What it's doing is it's just looking at that market index. Let's just talk about the S&P 500. That's the most common index that we use. It's looking at the S&P 500 and says, okay, in this year, what did the S&P do? Well, that dictates how much interest we earn. And so you can see here we're using a cap and a floor. So in a year where the S&P is up, we capture a portion of those gains up to a cap. Okay, and right now the caps are about 10% on the S&P. But then we have downside protection. In other words, in a year where the S&P loses value, we don't participate in those losses. We don't earn any interest in that year, but gratefully we don't have to participate in a 20, 30, 40% loss when the S&P is dropping. So that's the first kind, index universal life, or IUL. The second one is whole life. Buck mentioned this. And the primary difference with whole life is that the interest is growing. We have a guaranteed interest rate that we're earning inside of that cash value plus a dividend. And it's what we call an uncorrelated asset, meaning it's not tied at all to what the market's doing or what real estate is doing or whatever. It just grows in a very consistent and predictable way. So we use the combination of these two because we want to use their strengths. On the case of the IUL, the upside opportunity, more upside availability. We want that, but in years where the market is down, and again, gratefully, we're not participating in those losses, but we're not earning any interest. Well, we know we're going to earn interest on the whole life side. So their strengths balance the weakness of the other. Okay. So that's the vehicles. And again, I'm just going to hit on a couple additional pieces that come with life insurance. We've talked about tax-free income. Well, that's one of the huge characteristics of life insurance is the way that it gets taxed. When you're putting money into it, you're putting after-tax dollars in. As it's growing inside of that cash value, it's growing tax deferred, meaning you don't get a 1099 at the end of each year. And then ultimately, when you're accessing that money, you get to access it income tax free. And even when you pass away, that money passes on to your heirs income tax free as well.
Real quick, Rod, I know you're probably going to get into this, but I just want people to think for the next part that's important for this is going to involve putting leverage on these. So just for perspective, again, you said the IUL right now, what's the cap on the S&P 500?
About 10%.
About 10%. And so what that means is if your money will grow with the S&P 500 up to, now this is with no leverage, 10%. But remember, in these policies, one of the key things is that there is leverage. So, for example, you might be thinking, well, 10%, that's, and what if the market goes up by 20% like it did this year? Well, that's where the leverage comes in. And you can lever up that 10%. Basically, you're amplifying your upside there. And the downside, of course, here again, is the floor, which means you can't go negative, right? And obviously, that's one of the big issues with investing in the stock market is having a negative year. So if you can eliminate the negative years for the most part, and you can amplify your up years, and Rod will get into the numbers on that, that's where the magic really happens. And the same thing with whole life. The difference is if you don't have an appetite for even that kind of difference, between whatever 0 or there's even a floor of like probably 1 or something like that. 1 of 10, whole life is just going to give you a number and it'll be highly predictable, but you're probably not going to have nearly the potential upside. But again, when you leverage it up, the returns for that cash value become very attractive. But that's, I'm sure Rod will get into that, but I think it's important just as we talk about this to understand that we're using leverage in these. So.
Yeah. And that's, I mentioned a minute ago, but I think it would be worth on kind of in this context, what we're talking about here, repeating it, that these policies by themselves, before we do anything with the leverage, are going to create a predictable 5, 6, 7% tax-free return by themselves before we do anything with the leverage. And then when we add the leverage, that's where we are able to create that 12, 13, 14% return, again, tax-free. And so it makes it really powerful, especially when you compound it over long periods of time. You'll see the power of how that works. Okay, so next thing I want to hit on is that when we design these, we're going to match up the goals of the individual to the design that we're doing. And in a lot of cases, we'll set it up with a single contribution. In other words, the individual puts in a one-time contribution, and then after that, every dollar that's continuing to go into the policy, we're leveraging, we're using the financing to do that, right? This is the way to optimize the leverage, okay? And in a situation like that with a single contribution, then I can expect to be ready to start taking meaningful income in around year 12 or 13, okay? So in other words, it takes some time to bake, so to speak, to mature, to get to a place where it's ready to start kicking off meaningful income. And in a case of a single contribution, year 12 or 13. On the other hand, if someone says, oh, but that's a little too long, I don't think I could wait that long, then what we can do is design it so that instead of just a one-time contribution, you actually put 2 contributions in. And again, we're going to show an example of this and compare the two, but you might do that for one of 2 reasons. Either because you're saying, well, I want to not take as much risk, so I'll create a little more liquidity inside of the plan and create the higher net equity. And it also makes it so we can take the income sooner. Because of that higher liquidity position, we can be in a place to take the income sooner. So again, we'll show an example of this, but we have this conversation a lot where someone says, man, I like it. I want to use the leverage. I can't wait 12 to 13 years before I start taking the income. Great, no big deal. We just adjust the design to match up with what you're wanting to do. And we even have people who are set up to start taking income in as few as like 6 years. And so we would make multiple, more than even the 2 contributions on the front end to make that happen. Okay. So now I want to get into specific case studies, and we'll look at 4 different case studies. The first one is taking some of that lazy money. And I call it lazy money basically as we're working with people, especially people from your group, Buck, who invest in alternative assets right? They're business owners or they invest in real estate or notes or funds or all kinds of different things. But they also want to diversify what they're doing. And so they'll carve off some of their money and put it into the Wealth Accelerator to work alongside the other things that they're doing. And so we'll talk about an example like that, taking a one-time lump sum, dropping it in. Kind of A and B. The first one is using that money to create the retirement income. And then B, the second one, we'll take the exact same scenario, but say, well, what if they didn't take any income? If it was all geared toward creating this estate planning need, then what does that look like? So that's the second one. Then we'll do a comparison. So I talked about the difference between a single contribution versus multiple contributions before we start doing the financing, creating earlier income versus later. So we'll talk about that. And then on the final one, we're going to do what I'm calling a traditional retirement alternative. In other words, in this case, it's not just one or two contributions, it's phasing it in over time and what I call stacking the plan. So each year starting a new phase of the plan so that we're building towards retirement, but it looks a little more like what people normally think of in terms of building towards retirement, right? Not just a single lump sum, but something they're putting in on an ongoing basis for a number of years. Okay. So the first one, we're going to look at a 45-year-old business owner who has $500,000 sitting in their business reserves, and they want to get it to work, right? Start working for them inside of the Wealth Accelerator. And so they do that. They're able to generate a long-term almost 14.5% IRR. When we get to the point of taking the income, we're going to be able to take $18.3 million of tax-free income between the ages of 61 and 90. And when they pass away at age 90, there's an additional $14 million that passes on to their heirs. Okay.
So before you go on with this one, Rod, I think I might have given you sort of this example to work with, because this is a very frequent type thing that happens with doctors, medical professionals, because we're in school for so long. So, for example, in my case with surgical residency, I didn't finish until I was 32, 33 years old, and I had zero money, right? And so you're way behind a lot of your colleagues who are maybe went another route, much shorter training. And in this situation, all of a sudden you're 45 years old. So you're just, you're 12, 13 years out of practice. And, you've probably done okay, but you're starting to look and think, well, gosh, time went really fast and I'm supposed to have a whole bunch of money for retirement. What the heck am I going to do?
Yeah.
And this is a beautiful example of what you can do, because it is essentially, as the name suggests, accelerating wealth growth far more than your typical return profile.
Yeah, absolutely. And in these examples, we're using, for that exact reason, we're using a lot of examples for people in their 40s. But then I'll have people who come and they'll say, oh, but I'm in my 50s, right? And there's no time where you phase out of this, other than how soon do you need the money, right? How soon do you want to take the income from this lump sum that you're setting aside? And we have a lot of people in their 50s and even their 60s who use this strategy, and then we just build it to time the income that's right for them.
Those are pretty remarkable numbers when you just look at them on their own, though. $500,000 one-time investment, right?
Yeah. Yep.
Leading to effectively $18.3 million of income, 61 to 90, and then the death benefit of 14.2 million. That's incredible. But anyway, why don't you go on and tell us how we, the details, because the math is what gets you there. It's not hocus pocus.
So now we're going to look at this exact scenario and kind of how we build it out. So I know it's a lot of numbers on the screen, so I'm going to highlight some different things as we go. So up here on the upper left, you can see the initial 500,000 going in. Okay, that's the one-time contribution from this 45-year-old. And that goes into the insurance policy and starts to build the cash value. Okay. So this column, this total cash surrender value, represents the asset. Okay. That's the engine that's producing this. In other words, we're using leverage, But one of the benefits of using leverage is that the total amount that you have in the cash surrender value is what's working for you. Each year when you earn that guaranteed interest and dividend on the whole life side and the interest that's tied to what the S&P did on the IUL side, you're earning it on the total of what you see in this cash surrender value column. Okay. And that builds over time because you put the first 500 in, but then we continued putting 500 in every year using the leverage, right? So we're tapping into that line of credit to put another 500 in. When we do that, the asset grows. And I talked earlier about all this returns that we're talking about is after cost. Costs in these life insurance policies are somewhat front-end loaded. The first couple of years, you'll pay most of the cost, a lot less from year 3 onward. But over time, you can see how this is that 500,000 a year is just continuing to build and build and build, and compounding growth inside of the account. And then the part that we're interested in as it relates to any kind of short-term liquidity needs, this is our net equity column, which just means how much above whatever the loan balance is do I have in the asset. And this is what we have access to for those kind of short-term needs. Okay, that's the liquidity piece of it. And so you can kind of see how that is working because of those initial costs, because of some interest load that we have on the loan. You see that decrease a little bit for the first few years, and then from that point forward, continually going up. Even when we get to the point where we're taking the income, we're going to force that higher because it does a job for us. It's serving as the cushion for us for kind of those what if scenarios. And again, we'll get into more of that here in a minute. Now we see the income here on that left-hand side in this example, starting at age 61, starting at 381,000 and increasing to adjust for inflation over time. And again, we're showing it through age 80 just because of limitations on space on the screen. But in reality, it continues through age 90 and would continue beyond that, right? It's not something that would like fall off a cliff at age 90. If they live to 100, 120, however long they live, the income would continue for as long as they go. Okay. And then this spread column, I think, is one of the most important columns here because this again emphasizes how the leverage is working for us. In other words, what the spread column represents is it's the difference between the growth that we're creating on the asset inside of the cash value compared to the interest that we're accruing on the loan. Okay. So, and it's compounding on both sides, right? Compound interest on the growth, what we're earning, compound interest on the loan side. But what's the difference, right? How much more am I earning on average over a long period of time on the asset side? And just to be conservative in our approach, in those first 5 years, we artificially force that spread lower, right? Not because I'm saying I think it will be that, but just from a projection standpoint, being safe and conservative. And then by year 6 onward, then we're leveling off in this, it shows 1.94 for this example. We're typically right around that 2% spread number in these examples. And again, that's highlighting the difference between on average what I'm earning in the asset versus on average what I'm accruing in interest on the loan. And a lot of people say, well, that's not that much of a spread. How does that spread create such a large difference? And the answer is that there are two things are happening. Number one, the arbitrage that exists just by the difference in the interest rate is powerful. But secondly, the asset is always bigger than the loan. So if I'm earning a higher interest rate and that interest is being earned on a higher balance, then together, those work out to create the result. So we have that, again, 2% over time. Now, when we look at it over a long period of time, I mentioned the 14.42% long-term IRR on this. And basically what's happened is we look at the income that we received, right, year by year by year. And in addition to that, we look at age 90 and see what the cash value is. That's how we calculate that one. Oh, but in this case, we assume the person passed away at age 90. So it actually 14.54 when you increase, or when you take into account the additional death benefit that paid out, the total IRR earned on over the course of this, on that original 500 going in, was 14.54. And like you mentioned earlier, I get a lot of people who will say, man, I look at the numbers and I put the 500 in and as much coming out, it just seems too good to be true. Well, let me ask you this. Is 14.5% return an unreasonable number to think about?
It's the internal rate of return, especially. That's what you have to
Right.
think of.
Right. And so there are people, even today, even in the last few years, who have had investments out there earning at least this, right? Even in pretty simple, funds, mortgage funds or whatever, I see 8, 10, 12, and that's really simple stuff, right? But then when you include, I have a rental property, or I have a short-term rental kind of thing, then 14.5 doesn't seem unreasonable. And so it isn't too good to be true. It's just compound growth. What compound growth can do for you over, in this case, the 45 years.
Yeah, and I guess the other point to make there is that, of course, when you talk about 14.5 as an IRR in an asset that, you're in 3 or 4 years, that, the amount of return you get is great, but we're talking about a lot of years here, and we're talking about a lot of years in a really relatively stable growth environment, because you've got guardrails if you're using an IUL with a floor and a cap.
Yep.
Or if you're using whole life, you've got a fixed return. So it is basically a product of leverage, of low volatility, and low risk.
Yep, for sure. Okay. So now let's just recap again. This is the same slide, but I'm just going to recap again what we just looked at.
Hey, one more thing. Just if people are looking at the 500,000 number and thinking, I don't have 500 to do right now. That's just a number. You could do 100 grand.
Yeah. Yeah. Our minimum is 100, but yeah, you get to pick your number for sure. Yeah. I'm glad you mentioned that. Okay. So that's a recap of the one we just looked at. But what if we take the same person, 45-year-old going in, puts the 500,000 in, same kind of growth pattern as we just looked at, but they're not worried about taking income. Okay. We bump into this regularly where someone says, well, I have these other investments over here, or maybe I have some money that was in a traditional retirement account, and all of that together, I figure should cover my income needs. Great to know I can access it if I want to, but for planning purposes, I want this to be more of an estate planning play. So same 500 going in, same 45-year-old, but they're not taking any income. They're only focused on the death benefit. So if you leave it alone and let it continue to grow until you hit age 90, that's a $64.8 million death benefit that would pass on.
And again, to be clear on, who are the people who are potentially interested in this, it ends up being like, okay, I got this, and maybe I initially got it because I thought I might need the income, but as it turns out, I did great. Yeah. And I have other investments that I don't need to touch this thing. And I might as well just leave this big chunk for my kids and my grandkids. And, it cost me, in this case, $500,000 to do it early on, and it got them, close to $65 million when I die. So that's a different way to look at it. And I know early on, a lot of people didn't even think about those kinds of things, but if you start making money and you have this, the pressure is kind of off in terms of worrying about your heirs.
Right. Yep. And it can be anywhere in between, right? We were showing taking out, optimal income on the previous example, showing zero income on this one. Well, if you wanted to take some, but you didn't take as much, then to the extent I don't take the income, it will amplify what the death benefit is in the end. Okay. All right. So that's the first kind of A and B examples. Now let's look at our comparison, where I said, if you make a single contribution, then you might need to wait 12 or 13 years before you take income, but you can speed that up. So on the left-hand side, we see the single contribution going in on the front end. Again, similar number, 14.25%. In this case, we're taking income in year 13. This is on a 49-year-old Again, so they're at age 61, 62 when they're starting to take the income. And from 62 to 90, they end up taking 2.6 million of tax-free income. And when they pass on 2.1 million. Okay. But again, what if the 49-year-old says, you know what, I don't want to wait that long. I've worked hard. I'm wearing down. They're just driving me to the bone. I don't want to wait any longer than I have to. I'm going to retire in 10 years. Okay. Is that possible? Yes, it is. So you put your initial 100 in. The starting point looks exactly the same. The two policies with 50 going into each, 100,000 goes in year one. When year two comes around, the individual puts in another 100,000. And then from year three is when we start doing the financing and the leverage. So the first thing you'll notice is that the IRR is a little bit lower. Well, it makes sense, right? They had to put 200,000 in order to create this result. Why did we do that? So we could speed up the income, start taking it in year 10. Over the long run, partly because of taking the income earlier, right? 3 extra years of income, they end up taking a little bit more total income out by the time they get to age 90, again, with the $2.1 million death benefit. So again, but the difference here is they put in 200,000 instead of 100,000. So that's why the kind of like an inverse relationship on if I, to the extent that I want to de-risk it and or speed up the timeline, I'm also using less leverage. So my total IRR comes down a little bit. Okay. But again, we can custom build this to the individual, understand your needs, where you are, what your goals are, and then build a plan to meet those needs. Okay. And then our final example is, again, I call it the retirement alternative. So this is someone, 42-year-old in this example, who's going to be setting aside 100,000 a year for the next 10 years. And maybe up to this point, they were doing something in a more traditional retirement account, but then they found they saw the light, right, on the alternative investing side. They're starting to do that. And they say, well, instead of using this traditional, inefficient retirement plan, I want to start building towards retirement income using the Wealth Accelerator. And so I'm going to put 100,000 a year away for the next 10 years. So in this case, they put away a total of $1 million. But also in this case, we stack the policies. So in year one, we create that the first 100,000 goes in, and then we finance everything from year two onward for that one. When year two comes around and the surgeon's ready to put in the next 100,000, we're starting up new policies, stacking on top of the first policies we did, starting, think of it like phase two or tranche two. 100,000 goes in for year one, and we finance everything after that. So each year we're stacking new policies to build this out. And in this case, now again, $1 million went in, 14.8% long-term IRR, $43.7 million of tax-free income through age 90, and an additional $31 million of death benefit. Now, these numbers.
When are you assuming the retirement in this?
In this one, it's age 60.
Okay.
Yeah.
But you're only talking about $100,000 per year for 10 years, though.
Correct.
Right. So, right. Okay.
Yep. Exactly. Okay. So again, the case studies are there so you can see a variety of different ways that this can be built and kind of what the results are. But still in the end, people are like, well, just ultimately, how is this happening? And I talked a little bit ago about the spread that we're assuming on this. But it's really a concept called arbitrage. And arbitrage is basically where you're using leverage, you're growing an asset using leverage, and on average, creating a better return on the asset versus the interest on the loan. So here we have this green line represents a compound curve, the asset value as it grows over time. Were you doing it using leverage? And like I mentioned earlier, the interest on the loan is accruing and compounding as well. So it hits a compound curve as well, but the slope is very different. The difference between those two, that's the spread. Okay. And let's look at it in a single year snapshot now. So let's use, again, take a snapshot from an example where now we have $10 million sitting in the cash value. Like I mentioned earlier, that's where we're earning the guaranteed interest and dividend on the whole life side, earning the interest on the IUL side based on what happened in the market. We have at this moment a loan balance of 8.8 million. So our net cash value is 1.2. Okay. So I could think of it in terms of like if it's my balance sheet, it's a $1.2 million asset on my balance sheet, but in reality, it's $10 million out there that's working for me. So if we assume a 7% growth on the cash value for that year, that 10 million at 7% means I earn $700,000 for that year. Okay. At the same time, I have interest accruing on my loan at 5% on the 8.8 million. That's 440,000. So my net gain for the year was 260. Well, if I take that 260 and say, well, what kind of a percentage would I have to earn to get 260 off of my net equity, the 1.2 million? Well, the answer is I'd have to earn 21.6% on the 1.2 million for it to earn 260. To Buck's point earlier, we're not earning 21% in a policy, but we don't have to. All we had to do is earn the 7. That compared with the 5 means that my net gain on the 1.2 million was a 21.6% return. And I'm not saying we're getting that every year. This is just one example on a snapshot. But the point is that of showing this is just to show the value of that amplification of what the leverage is doing for me, because I have this much larger asset out there that's actually doing the work. Okay. Now, last thing I wanted to talk about before we go to questions, and that is people say, well, everything has some risk associated with it, right? And I absolutely agree. So with Wealth Accelerator, we have 2 primary risks. One is rapidly rising interest rates, and the second one is long-term losses in the stock market. And I say long-term because short-term, like a single year of the market being down, we didn't participate in those losses. But then what happens is I get reset to the lower value. So let's just use an example. Let's say the S&P is at, let's use round numbers, 3,000 value the beginning of the year, and it loses and all of a sudden ends up at 2,500, right? Well, again, I didn't participate in those losses, but the next year, as I'm moving into the next year on my IUL, I reset at the lower value. So any growth up from the 2,500 value, I'm participating in those gains. So normal volatility actually works to my advantage because of the way that works. But if there's long-term, Great Depression, right? 3, 4, 5, 6 years in a row, that's where it becomes more of a risk as it relates to this strategy.
Well, I was going to point out too, even during the Great Depression, you had years where there was a positive delta in the stock market. So if there's an overall depression in the economy, but all you're basing it on is the year-to-year delta, that changes even, a depression scenario a little bit, right?
Yeah, exactly. Yeah, and along the same token, when you look at interest rates, the interesting thing about interest rates is a shift in interest rates affects both sides of my equation, right? Obviously, it affects loan rates, right? But it also affects what I can earn inside of the policies, because in a rising interest rate environment, the caps on the IUL go higher. 2.5 years ago, before interest rates started going up, the caps were right around 8.5%. But now over the last couple of years, they've risen. They're at 10, right? So, and a similar thing happens on the whole life side with the dividend. In a rising interest rate environment, the dividend adjusts and goes up. So in both cases, number one, we have to recognize what the risks are. But number two, we're building this in a way to account for those risks. And what I mean by that is, number one, this long-term nature of it, right? We're not saying, hey, this is going to take us to the promised land in any 1 year or 5-year period. These are long periods of time. When we average out the average growth compared to the average interest on the loan, that works to our advantage. But then secondly, remember that net equity column, and I talked about how that also creates or serves as a cushion. So in years where the market did drop again, gratefully we didn't participate in the losses, but we didn't earn interest on the IUL side, we can end up with a negative arbitrage because of the interest accrued on the loan that eats into the net equity. but that's another reason why it's there. That's also why even when we're in this income phase, we continue to push that net equity higher and higher, because as the loan gets bigger, I need a bigger cushion. And so we're factoring these things in to help to understand and account for those differences. And then a couple of last points here. We can adjust this to match someone's risk tolerance. So if someone says, well, I like the idea of using leverage, but maybe not quite to the extent you're showing here, well, great, we can design it in a way to where you get that. And maybe an analogy to that is someone wants to invest in real estate. They want to use leverage, but instead of a 20% down payment, they make a 50% down payment, right? Similar idea here. We can design it to do the similar thing. And then the last point is, we've done a lot of stress tests, including the Great Depression, including the 1980s interest rate scenario, so that we understand what it looks like in those scenarios, so that, again, we can build it to withstand and continue on. We don't know what the future holds, obviously, right? But we can learn a lot from what's happened in the past, again, especially when you extend it over long periods of time, so that when we use the words of consistent, predictable, conservative, those are the reasons why we can do that. Now, just to wrap things up, so we've talked about how the Wealth Accelerator is a way to create maximum tax-free income, create predictable double-digit returns. We can stack policies and build it as we go. It's a good way to get inactive money to work while still having checkbook access for short-term needs, and the optimal leverage, self-contained, right? We're not including anything else in this. The asset that we're building on its own is enough to cover the needs of the collateral.
One of the things I think is important to remember is as impressive as those income numbers sound, the way they grow, it's actually even better if you consider the fact that Rod keeps calling it tax-free income. So we've got this internal rate of return that you're looking at, but if you were going to get that return in, say, the stock market, or something like that, then you'd be pulling that stuff out and getting taxed on it before you used it, or when you use it. In this situation, it is truly tax-free income, because basically what you're doing is you're borrowing, right?
Yeah.
That's really what you're doing, and there's no tax on borrowing. Can you explain effectively how that works?
Yeah. So when it comes point to take income, we're tapping into that line of credit, again, using the cash value as collateral to do that. But we're pulling the money out of the line of credit to take that income. And so we're using the benefit of the loan that helps us on the tax side. But then ultimately, the loan is going to be paid off when I die, and this income tax-free death benefit pays out. So the loan is being paid off by income tax-free dollars. That's what completes the cycle. It's not even that I'm passing the tax burden on to my kids or anything else like that. The death benefit makes it whole.
Another question I would have is that if you think about how all of this is really just sort of the power of, all the amplification, the relative stability, and all these things together, and then again thinking of it as tax-free income, one of the thoughts that comes to my mind is, well, we all think about our kids and taking care of them, and we certainly have the estate planning option here too. But what has anybody ever done this kind of as a, I'm going to do $100,000 plan on my teenager, and that's going to be their retirement. That's going to be everything, because it's going to compound to so much by the time they're ready for it.
Sure. Yeah.
I guess the age part of it comes down to, how much can you qualify for,
Right. Yeah. So a teenager, we wouldn't be able to get 100,000 policy for them, just because the insurance gets to be so big for a person that age.
Right.
But your point is right. So we've had situations where, as a family, they come in and they say, hey, we like this strategy. So on mom and dad, we'll put, X amount towards their policies, and as much as we can get towards the kids. The idea being as a starting point, right? When they get into their working ages, and now we can justify more insurance, and we can continue to build that out. But no reason to not get started with what you can while they're younger.
And do you have a sense for like when actually you can, when it sort of makes sense to potentially be able to, how young can you be?
Yeah. So, I mean, a newborn, we can write a policy on and put maybe 5,000 or 6,000 a year into their policy.
Yeah. Right.
A 15-year-old, 18-year-old, we can start to get into the 15,000 a year range.
For
But
you wouldn't really do this kind of premium finance on that though, right?
Well, you could. And like I said, that's where, think of it like the Wealth Accelerator is a plan, a strategy. And then the actual policies that we create inside of that can be a combination of different people, right?
Right.
So again, we did one with the family, mom and dad and the 2 kids. They did a total of 100,000, and but we got as much as we could in on the kids initially, right? Okay, great. Therefore that's whatever, 20,000 of it we got on the kids, and then the other 80, 40 for mom, 40 for dad.
Yeah. Got it. If you want to reach out to Rod, easiest way you could do that probably is just go to wealthformulabanking.com and put in your contact information for a free consultation with Rod. And he'll go over your personal situation in as much detail as you want. There's not really any questions these guys can't answer. A personal experience with them, having done policies for me, multiple times. So again, it's wealthformulabanking.com. Otherwise, you can also, if you got an email from me on this, you can certainly just reply to my email. That might be easiest, and I'll just forward it to Rod. Or you could do rod@wealthformula.com, right? So, Rod at wealthformulabanking.com. Yes, indeed. Rod at wealthformulabanking.com. Anyway, that's it for today. Rod, thank you so much for your time, and thanks for everybody for joining us.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for, and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. And as Rod laid it out for you, I mean, if it's of interest to you at all, there's no reason why you shouldn't get a free consultation with Rod. Go to wealthformulabanking.com. Check it out there. That's it for me this week. Well, actually, it's not it for me this week because we still have our show on Wednesday and we have our show on Friday. But it's it for me today on Wealth Formula Podcast. We'll talk to you later.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.